The United States stock market is officially closed today, Friday, July 3, 2026, in observance of the Independence Day holiday weekend. So we are looking directly at the final numbers from the last active trading session. Nokia closed that session at exactly $12.07 per share, marking a significant intraday drop of 6.51%, which wiped out 84 cents from its equity value on massive volume. When a massive global infrastructure player drops over 6% in a single day right before a holiday weekend, the immediate expectation among retail investors is that the sky is falling or that some hidden bad news leaked early. But if we pull back the curtain on the actual transaction records, the reality tells a completely different story. This recent drop to $12.07 was driven heavily by institutional blocks adjusting their risk profiles ahead of the upcoming second quarter earnings release on July 23rd. While everyday traders using the Robinhood app or checking their balances on SoFi Investing might see a red day and panic, large asset managers are utilizing options markets to hedge their massive physical positions. Over 360,000 options contracts changed hands during that single down session against a backdrop of a massive 3.7 million contracts in total open interest. This level of derivative activity indicates that sophisticated market participants are positioning themselves for an aggressive breakout or breakdown rather than a slow decline. The standard market expectation is that Nokia is a slow, boring telecom utility that stays anchored to a tight trading range, but the structural reality is that the stock has evolved into a highly liquid, volatile battlefield for institutional capital. When you look at popular investing sites or search for online investment help, the general consensus portrays Nokia as a relic of a bygone technological era that is struggling to preserve its margins against fierce competition. People often group it with slow-moving value plays, recommending it only for conservative long-term portfolios that focus exclusively on steady dividend yields. If you are focused on self-investing through an individual brokerage account, you might have been told to ignore this name in favor of hyper-growth tech giants. That is the expectation. The reality, however, is that Nokia has quietly staged one of the most aggressive structural transformations in the modern technology sector, shifting entirely away from consumer hardware and embedding itself into the fundamental fabric of global cloud connectivity and defense communication networks. Over the past 12 months, the stock has rallied from a 52-week low of just $4 to a massive high of $17.45 per share. That is not the behavior of a dying legacy utility company. Investors managing their own portfolios via Robinhood stock trading or active accounts on the Interactive Brokers platform have watched this asset transform from a forgotten, low-priced stock into a highly traded corporate entity. This stark disconnect between what the average investor thinks Nokia does and what the company is actually building creates a massive structural gap in valuation, which is exactly why the recent price volatility has caught the attention of major Wall Street firms. To truly understand the recent daily swings and the massive 78 million share trading volume we saw at the close, we have to look closely at the macroeconomic pressures hitting the broader communications equipment industry. Global telecom spending has faced a notable cooling phase as massive carriers slow down their initial phases of infrastructure deployment. Yet while the market expected Nokia to suffer a massive drop in revenue, the company has managed to counteract sector headwinds by securing high-profile military and defense contracts. Recently, the company expanded its defense offerings by providing highly secure tactical communication solutions for military operations, collaborating directly with major global defense contractors like Lockheed Martin and specialized state agencies such as the Finnish Border Guard. This pivot into government and defense infrastructure represents a massive, highly stable revenue stream that remains entirely insulated from consumer market downturns or corporate enterprise spending cuts. When institutional funds place capital through high-end corporate services or manage multi-billion-dollar portfolios using Fidelity wealth management platforms, they look for exactly this type of stable sovereign revenue. This institutional interest explains why block trades have surged, even as individual retail sentiment wavers during short-term market corrections. Let us look closer at the immediate trading patterns that led to the current $12.07 valuation. The stock has been facing a technical cooling phase after failing to reclaim its heavy overhead resistance near the $15 mark. Throughout the month of June, the asset experienced wild price swings, rising over 4% on certain days, only to give back those gains during subsequent trading sessions due to broader index rebalancing. For instance, on the New York Stock Exchange, the trading desks using Interactive Brokers stock trading tools saw heavy institutional selling pressure that pushed the stock down from its late June highs. Yet every time the stock approaches the major support zones established near the $10 and $11 psychological levels, massive institutional buying materialized to stabilize the asset. This indicates that major asset managers, including those who construct automated strategies for platforms like Schwab Intelligent Portfolios, view these pullbacks as ideal accumulation zones. The volume spikes we are seeing are not retail panic sales, they are structural handoffs where short-term speculative capital is being absorbed by large corporate treasuries and long-term institutional vaults. If we analyze the internal mechanics of the company, Nokia operates a highly diversified business model centered around three massive core pillars, which are mobile networks, cloud and network services, and network infrastructure. They also hold a massive, highly profitable patent portfolio managed under their technologies division, which generates high-margin licensing revenue from smartphone manufacturers, automotive companies, and consumer electronics brands globally. Unlike a standard software firm, this company builds the actual physical hardware, routing systems, optical fiber connections, and base stations that allow the internet and mobile data networks to function. When you browse financial media or research different investing sites looking for online investing ideas, it's easy to get distracted by flashy consumer applications. But the physical reality is that every time an enterprise customer executes a trade on a high-speed Fidelity trading platform or transfers funds through the SoFi trading platform, that data is highly likely traveling through network switches and fiber architecture manufactured by Nokia. They are the invisible toll collectors of the global digital economy, earning consistent fees on the transport of data regardless of which individual consumer application happens to be popular at the moment. Now, I want to hear from you directly to gauge how the community is positioning itself in this environment. Comment below how many shares of Nokia you currently hold in your portfolio, and let me know if you are actively buying this recent dip or waiting for the upcoming earnings report before making your next move. It's always fascinating to see if retail investors are matching the aggressive accumulation patterns we are witnessing from the major institutional blocks. When you look back at historical performance reports from previous years, Nokia used to be plagued by low gross margins and intense price wars with overseas competitors. For a long time, the common narrative on various self-investing forums was that the company could never achieve structural profitability because the physical equipment business was too capital-intensive. That historical data is what shapes the current conservative expectations surrounding the stock today. However, if you examine the recent financial statements available on the Fidelity mobile app or through independent individual brokerage research portals, the fundamental reality has completely changed. Nokia has aggressively optimized its supply chain, cut billions in operational overhead, and shifted its focus towards high-margin software-driven network management tools. Their gross profit margins have recovered significantly, and their net profit margins have stabilized even during quarters where total revenue faced minor contractions due to global supply chain adjustments. They have maintained a healthy balance sheet with a massive cash cushion, allowing them to consistently fund research and development while supporting share buybacks and a reliable dividend distribution. This fundamental strength is exactly why prominent European banks recently upgraded the stock to a definitive buy rating, setting aggressive price targets that imply significant upside from the current $12.07 closing price. Looking ahead toward the final half of the year, However, the future outlook for this company depends entirely on the tension between market expectation and structural reality. The dominant market expectation views this company as a legacy hardware manufacturer trapped in a slow growth industry, resulting in a conservative valuation that many analysts treat with indifference. The actual structural reality reveals a nimble, highly profitable technology leader that is aggressively securing sovereign defense contracts, dominating the private enterprise network space, and generating high-margin cash flows from an extensive global patent portfolio. The recent intraday drop to $12.07 per share represents a classic technical cooling phase driven by short-term options hedging and institutional risk management ahead of the July 23 earnings date, rather than a fundamental degradation of the business model. As the gap between public perception and physical corporate performance inevitably closes, the underlying financial metrics suggest that long-term investors who understand this structural transformation are looking at a deeply resilient asset that is quietly building the invisible foundation of the modern digital landscape. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.